Hello, my name is Paul Hopkins and I'm the Director of Acquisitions here at CPI Capital. And today I am going to do a deep dive into the underwriting on our new acquisition called Apollo Oaks, located in San Antonio, Texas. So, Apollo Oaks is a build to rent community where we are actually selling off the finished duplexes that we are building to an end buyer at the certificate of occupancy stage. So it is a bit of a unique model that needed to be created, and I built this model from scratch to account for this particular deal. Now, normally we're an apartment acquisition firm, and I didn't feel that it was quite right to use our apartment acquisition model for this particular deal. So I created it from scratch, and so I'm going to dive into how I built this model and the assumptions that I used in order to complete the overall underwriting on this deal. So this property is called Apollo Oaks, and it's located in Helotes, Texas, which is a suburb of San Antonio. It's in the northwest quadrant of San Antonio in Texas. And the overall investor returns is 28% IRR, 50% ROI, which is a 27% averaged annualized ROI or a 1.5 equity multiple. The project timeline is completed in less than 2 years at 1.8 years, and we're developing a total of 60 units. So we're building 30 duplexes, so a total of 60 units. The lot that you see right here, it is a bit of a unique shape, but I'm going to actually pull up the design plans that we have from our engineer. So we've already engaged the civil engineer to move forward with the planning and permitting, and this is actually going to reduce our overall timeline for the investors and for the overall project. We had believed in this project basically the moment we started looking into it, that we engaged the civil engineer early, and which is going to reduce the overall permitting timeline, and that is of course boost the investors' returns. And so I've accounted for a little bit of that. I'm going to explain where I'm also taking some risk mitigations in our overall scheduling timelines. But this is the lot, the land that we are purchasing, and it is a bit of a unique shape. Where there's a little over 8 acres of land here, but there's about 7 acres of developable land. And it has this little sliver here that really can't be used. So this is the overall lot, land, and what our engineering team has come up with is utilizing the land in its best capacity. And so there is going to be one road coming in with a T-head or hammerhead at the end that allows for emergency vehicles to come in and turn around, such as a fire truck. And then it has basically an intersection or additional streets here at the entrance that allow for more units. So when you look at this lot here, you'll actually count up that there are 32 lots that are being developed. And initially when we looked at this deal, we assumed that there was about 30 lots that could be developed here. But that could still change, coming back down to 30 lots, depending on the city approvals and permits. But right now, the plan is showing 32 lots that are being developed, and it all depends on basically this open space, which is a drain easement that is required for this land. So that could change, and that could also change the number of total lots. So right now, I'm just assuming that there's 30 lots that we're developing. It could be up to 32, and I'm going to explain how that is a benefit in the long run. Based on our financing and how we're structuring the deal. So everything is based off of 30 units, but this is the current plan that we've received from our engineers. And so, like I said, they've already started working on the layouts, working on the water distribution plan. This is the water distribution plan and the overall sanitary and sewer plan based on the overall land use capacity and what this engineering group is experienced with. So we've engaged Pape Dodson, a very large firm located in Texas. They have a huge office in San Antonio. We had the chance to actually sit down with them, go through the plan, talk about their the overall lot and the business plan. So great group of engineers. Happy to be working with them. They've also provided us their overall schedule for development. And so they started back in January. They already did the topography survey and lot layout, and they're now working with Bexar County and City of San Antonio for the permitting and getting that moving forward. And so they were saying that basically we can start construction based on their experience. They push through hundreds of deals in a year with the city, and so they're very fine-tuned with the permitting process. And they were actually saying that we could start our construction as late as end of May, but I have it actually in August that we're starting our construction. And the reason that I say that August that we're starting our horizontal construction is because there's a comment in here about a bird survey, meaning that there's birds that are nesting potentially in this area. It is heavily dense with trees. And if there is a record of this specific type of bird that is nesting in that area, we're not allowed to disturb those basically that nesting period until August. And so there is that potential risk. However, we can start earlier. But in my underwriting, I'm assuming that we're starting in August. So I just wanted to share that with you as far as what the civil engineer is telling us when we can potentially start our horizontal construction. So going back into my underwriting here, so we're developing 7 acres with 30 lots, and there are basically a duplex per lot, so a total of 60 units. Each unit is 1,400 square feet in size, so each lot is 2,800 square feet of rentable space. And now I'm going to jump down into the project timeline. So how did we come up with basically the timeline for this construction? So this is based on experience with the civil engineer that we've hired and also our development partner. Our development partner is Invest 5S, located in San Antonio. And I'm just going to pull up a slide here about Invest 5S. They are local to San Antonio. The team is led by Clay Schlinke, and it is a family-owned and operated business since 2012. Clay's got 30 years of experience in development, in construction, and he's been developing this type of product over the last 20 years. So he's developed over 4,000 lots in the region. He's on track to develop between 750 and 1,000 units this year in 2025. They're also vertically integrated, so they're a developer. They're also broker, so they sell these units to end buyers at the end of the day. And they also manage these properties as a complete build-to-rent community. So they also have a property management division within the company. And like I said, they're located in San Antonio. They're currently finishing up a project called The Row at Dietz Elkhorn, which is about less than 20 miles away from Apollo Oaks in San Antonio. So very similar type of project. It is one road in and one road out. They, excuse me, are developing 27 duplexes. They closed on this land August 15th of 2024, and they started framing later that month. So they already got the permitting taken care of before they actually closed on this land. but they were able to complete their first building in less than 3 months. And they're also going to be complete with the entire project by March of 2025. So next month from the date of this recording. So it's less than 8 months that they were able to knock out these 27 units. All the units that you see here that they're developing have already been pre-sold to the investors. And once the certificate of occupancy has been received, they that's when they're able to actually close on that sale. And this is the exact model with basically the overall cost, schedule, and floor plans that we are going to be using for Apollo Oak. So taking, what's already been done, it's basically duplicatable. And Clay and his team at Invest 5S have done this over and over and over. We had the privilege of actually walking this project and seeing the progress, looking at the quality of the projects, and we're quite happy and impressed with how they were doing it. Their superintendent and project manager that was on the project, walked us through a couple of the units that they were building, and he basically said, they do this over and over and over again, that he's able to frame out a house without any plans. That's how systematic that they have this dialed in. So, taking from the experience that our development team has, Invest 5S, they already know the exact costs. They already know the exact timelines for doing this. However, I built in a little bit of contingencies in my underwriting to account for any hiccups along the way. So that's how we were able to develop our overall project timeline. So we're assuming that we're going to close on the land March 30th, and that it's going to take us 4 months to basically receive all the permits to the end of July. Horizontal construction timeline starting at the end of July or August 1st for our 4-month timeline. And if you recall back to what the civil engineers were telling us, they said we could probably start at the end of May. However, I pushed it all the way back to basically starting in August. And they've got basically 4-month timeline as well within their project schedule. So going back to my underwriting. So once, and I also got a Gantt chart over here with some fancy colors to kind of mimic what's going on here. So again, we're acquiring it in March 31st, and then we're doing the permitting timeline up until July, starting at the end of July for the next couple months, for 4 months. We're working on the horizontal construction. Horizontal construction basically means putting in all the infrastructure. So that's water, sewer, electrical, all the curb and gutter, and basically grading the entire land ready for us to build vertically. So the vertical construction happens once the horizontal construction is complete, and we're breaking it down into basically 2 phases. So we're saying we're going to build phase 1, which is 15 lots over 6 months, and the next phase of 15 lots over 6 months. And if we look back at the layout here, so starting basically at the back end of the lot or the land, and working our way towards the front. So we're finishing all, basically selecting 15 units to phase in the vertical construction here. And then once that phase 1 is complete, then we'll work on phase 2. Now, if you recall, our partners, they were able to basically build the first house within 3 months and complete all 27 duplexes in 8 months. So, in my overall underwriting, I've said, okay, we're going to break it down into 2 phases, 6 months each. So we could accelerate that, and that's always our plan, is to accelerate our construction, because time is money, and we believe in the velocity of money and time, and we want to knock that out quicker. But in my underwriting, I have to be somewhat cautious of potential delays but in planning for the worst and hoping for the best sort of outcome. So with the 6 month timeline for each of the phase, starting November of this year and ending in May of 2026, and I continue to show that timeline here. And then once phase 1 is completed, then we start phase 2. But also when phase 1 is complete, that's when we could actually start to sell these lots. Or the completed duplexes to the end buyer. And the strategy that our partners, Invest 5S, have always done is they are able to pre-sale their units. And if you recall back on their latest project, Dietz at Elkhorn, they were able to pre-sell all their units to the investors before they even completed and during the construction timeline. So what I've assumed here is it's going to take us 2 months to sell off basically the 15 lots from phase 1. Okay. And then once phase 2 vertical construction is complete, basically by November 30th, 2026, then we need another 2 months to sell off those 15 duplexes. Okay. So the overall timeline, coming out to just under the 2-year limit here. So basically completing within the 23-month period. So like I said, because we are pre-selling these lots, that this timeline can be obviously compressed, and then our vertical construction, we hope to compress that as well. So overall, reducing the investor timeline. So as far as some cost assumptions, so development cost per lot or duplex, our partners were able to basically build the Dietz at Elkhorn lots or duplexes for $235,000 a unit, and I've increased that to $240,000 just for inflation purposes. And we could talk about tariffs as well. Tariffs is another wild card that could impact. I might as well talk about tariffs right now. And so, diving into the overall construction costs on this project, $235,000 is the past cost for the Dietz at Elkhorn. And if we introduced inflation, okay, so inflation would impact lumber in any petroleum products such as asphalt shingles, or the asphalt coming in for the road, and of course fuel for equipment. And we looked at what would be impacted on the costs of all the construction items within our overall budget and our detailed budget of costs. And it basically impacts about 8% of the total project. So, it could increase by 8% of the total project. So maybe around $10,000 to $20,000 of extra costs if they introduce the 25% tariffs. And that's on the high side. And what I did is under my sensitivity analysis, we talk about that. So that a total of 8% increase, which is that $20,000 increase here, and a 10% increase coming out to 264. And I'll get into the sensitivity analysis here in a little bit more in the video. But for now, they're building these things. They've had a track record of 235,000. I've increased it to 240,000 to account for inflation for the next year. And what we're also doing is we're issuing basically, the formal request for quotation out to any subs and suppliers when we start this project, and we're locking them in on a PO, meaning that we're locking that price in. And so, that price will not fluctuate over the next 2 years while we're developing this project. We're locking that price in up front. And so we know what those actual costs are going to be once we have those final quotes in hand. As far as the sale price per lot or duplex is $625,000, and Dietz Elkhorn, their average sale price is $650,000. This is a property. Dietz Elkhorn is further away from downtown San Antonio, further away from all the closed shops and amenities that Apollo Oaks is located to. So the other challenge is that there's no real duplexes that have sold in San Antonio that are a good comparable. Like, there are none. You can't find any. And so we're using the numbers that are being used at Dietz Elkhorn. They're selling them at $650,000 on average. And I'm assuming, okay, well, let's just account for any challenges. So I've assumed $625,000. So I reduced it by $25,000 on the sale price per lot or per duplex. Our sales costs, so using a broker for this, and then we've also included a disposition fee for additional management for negotiating the prices with the sellers, and the coordination and assistance for helping on the sales at the end. And then we also have included this is a great trick that we're actually doing is we're including a rate buy down for the end buyer. We're paying for that. We've allocated basically 7.5% of the sales price of these lots to be allocated to paying for a rate buy down to the end buyer. So basically right now, assume that an investor was coming in and buying this lot or this duplex, in today's rate, it's basically, call it 2 points over the 10-year treasury. So assume that the 10-year treasury is at 4.5%. 2 points over that comes out to 6.5%, and that's what their interest rate would be, is 6.5%. However, with us paying for a rate buy down, we're actually able to get their interest rates from that 6.5% down to potentially 3.5% to 4%. So it makes it so much more attractive to an end buyer and increasing their overall cash flow. So, for us to incentivize and make it very attractive for buyers to come in, we've allocated 7.5% of the sales costs to pay for that rate buy down. And that's all included in my underwriting, still achieving that 28% IRR. Now, not every end buyer is going to use that, but that is going to be our tool for additional concessions or negotiations or anything for the end buyer. So we've not necessarily get that we're going to use all that, but that's already baked into the underwriting. So, and I'll cover that a little bit more as I go down in the underwriting here. So as far as sponsor fees, we've got acquisition fee, which is 2% of the total project cost, construction development fee, which is 5% of the development costs. We have a loan guarantor fee, 2% of the loan amount. This is a recourse loan, so there is some inherent risks with using or securing this loan. We also have an asset management fee of 2% of the development costs and a disposition fee of 2% of unit sales, and that disposition fee is located in the sales costs, and I'll show that breakdown further. So the total amount of equity required is $3.4 million. In the actual the GP, so CPI Capital and our partner Invest 5S is contributing up to 10% of the equity needed for this deal. The overall waterfall structure is we structured in a 12% preferred rate of return. So that 12% it's definitely on the higher side, but this is a development project, so the development usually comes with a little bit more risk than an already cash flowing asset such as an apartment building, where the preferred return might be somewhere between 6 and 8%. So we've increased that to 12% to secure basically a higher return to the investors, right? So once the 12% IRR or preferred rate of return has been paid back, plus the principal, the principal from the equity that the investor invested, and we hit that 12% IRR, we're doing a 50-50 split between the GP and LP. And then anything over 25% IRR to the limited partners, we're splitting it 70% to the GP, 30% to the LP. So there is an incentive for the GP for us to push harder on the construction and the timelines and the costs and the sales. So but then everybody wins, right? So we're getting higher IRRs back to our investors, and that's our number one goal, is to get the highest IRR possible back to the investors and get this deal wrapped up as quickly as possible. So breaking down the costs of the project. So we've got the land acquisition. So we're buying the land at $1.5 million. We've got an additional cash reserves in here of $90,000, which is about 1% of the development costs. This is just to protect us against any other inflationary items. So if we don't use those cash reserves, that goes back to the investor once the sale of the lots are all complete. And of course, we have closing costs, which including all our legal, our lender fees, title insurance, all that. So we've allocated $170,000 to set aside for that. And I've got a detail in our closing cost timeline here. As far as the legal and accounting, application fees, environmental, appraisal, physical asset and due diligence items, title search, additional travel, coming out to $170,000. All right, now, so a total of $3.2 million. And how I have that structured is I actually have all that structured to happen all up front. And I'm going to get into why that's important here in a little bit. So as far as closing on the land, we need the $1.5 million and the closing costs to cover that. But the rest of the fees and cash reserves aren't necessarily needed up front, but I've got it modeled all up front here in the underwriting. If it was pushed back later on, then that boosts the returns. But if I have it all front loaded in the beginning, it's just showing that we need all that equity up front, and it's that all that equity is now time spanned over the entire project. Soft costs here. So we've got, and these are all well-known costs that have come from our developer. We've gone through their financials. We've gone through their costs on Dietz Elkhorn, confirmed all these costs with them. But breaking it down, we've got city planning services, platting fees, tree fees, boundary survey, property taxes, permits, and general administrative costs, additional insurance and taxes, and then engineering for all the lots. So the engineering that we've already engaged, Pape Dawson, charging us around $7,000 a lot for this. So we already have that quote of $210,000. And then these are also known costs, $3,500 per unit, coming out to $210,000. And then all these additional known costs. So these are what's known as our soft costs. So soft costs basically relating to engineering, permitting, planning, not necessarily putting a shovel in the ground or swinging a hammer. So that's what's associated with soft costs. Then we get into so the total of soft costs is $589,000. Then we get into the total hard costs, So that's the infrastructure cost. That's $40,000 per lot. Includes water, sewer, electrical, gas, stormwater fees, putting in the pavement and foundations, or the reports for that, and then mailboxes as well. So that comes out to 1.2 million. And then the vertical construction. So we got both phases, phase 1, phase 2, at 240,000 a unit, for a total of 7.2 million. So the total project cost coming out to $12.2 million. And how I've got this now modeled, like I said, all the land costs and fees is happening basically in month 1 in the underwriting. For all the soft costs, these are all happening over the next basically 5 months, and if you, which is in line with basically our project timeline of the permitting being over 4 months. So I've got it basically over 5 months, and it's an S curve, meaning that it ramps up in cost. So as you can see, it starts off this $210,000 starts off at $7,200 in month 1, ramps up to $50,000, $95,000, down to $50,000, down to $72,000. So it's kind of like a bell curve or an S curve. And so that it's a little bit more realistic type of approach. But that's all happening over the next 5 months. And then we get into the actual hard costs, developing the land. Again, that's an S curve happening over the next 4 months, from month 5 to month 9. And so you can see here the costs related to the overall timeline and schedule. Okay. And then our hard costs being an S curve as well, over the periods that I've explained up here. Okay, so everything is basically in line. So once we get the vertical construction starting off in month 9 here is when we're starting to see some of those vertical constructions happening here. So starting off here over the next 6 months, and then again starting here over the next 6 months. Okay. So down here you can see the costs associated with the project per month. So starting off at 3.2, which includes our land acquisition and other fees, as well as some of the soft costs associated with it. But then, getting spread out over the next 21 months here. And it's all following basically an S curve. Now, as far as the debt, the land acquisition itself and all the fees are not going to be financed by debt. We're actually using the land as collateral for this, which allows us then to get 100% loan to cost for the soft costs and hard costs for the horizontal and vertical. And so we had the chance to meet with a lender in San Antonio, explained our business plan, and Invest5S has also used this lender on multiple other projects. And it's pretty much the same story over and over and over. They're able to secure 100% of the construction costs for soft costs, hard costs, at 100% LTV, and up to about 10% interest, and that's 10% interest only loan. And they have quoted us at 2% financing fees, or actually they did quote us at 1%. But there is another lender that Invest5S uses that does go up to 2%. So I've increased this financing fee to 2.25% to account for just if there's change in negotiations with the lender. So at least baking in a few more fees that we need to pay. Not necessarily that we're going to have to pay that, but I wanted to at least include that in the underwriting. And if we don't use that, then there's actually going to be a bonus on the back end to the investors, where that fee has been reduced. Okay. So going back, land assumption or land debt assumptions, it's 0. We have to pay all for cash on that. But then as far as the soft costs, 100% loan to value, starting off in month 1, and the interest rates it's actually going to be accrued. We're not paying the interest until we are selling off the lots at the end of the day, and I'll show later how that plays into effect. Okay, so I covered the soft costs and hard costs for the debt and financing, but the financing fees here, the 2.25%. So $13,000, $28,000, and I have to slide over a little bit more. $162,000. That's all paid up front. So that's equity that we require to pay. And I have it actually modeled for when we actually start those draw requests. So coming down here, the overall capitalized construction interest, total of $320,000 in construction interest that will be paid from the sale of the duplexes at the end. So everything is accruing and it is accumulating on top of that. So I've got that modeled in here, how that's being accrued. But the financing fees of $203,000, that's all coming from equity. It's not being financed. So total project costs after debt is 12.7. So total cost before debt is 12.2 and 12.7 for the after costs, which comes out to basically $425,000 a unit. And we're selling these for $625 a unit. Okay, so overall sources of capital, again, so 27% of the total capital is going to come from equity, which is 3.4 million, and 73% is coming from our debt at 9.3 million for a total of 12.7. The overall cash flow of sources. So, we're basically funding everything with the equity first. So that's equity first of 3.2 million, and then our financing fees of 203. That comes out to the 3.4. And then as far as our debt, 100%, the percentage of each sales will pay down the loan on the back end. So construction debt before the interest reserves, 71% of the overall sources, 9 million, and then interest reserves of 3.2 coming up for our total sources. So that's the sources and uses. So then I get into the actual reversion or the sale of these lots. So the first lots are going to start for sale in month 15, and that's phase 1, and then phase 2 will start in month 21, and those are assumed a straight line projection, not a bell curve. Conservatively run it out over those 3 months, 2 to 3 months. And so we're selling each lot at $625,000. So phase 1 total sale price of 9.3, phase 2 at 9.3. So total lot sales 18.7 million. Okay. So if you remember, the sales costs and the rate buy down that we're also including, so that 8%, so out of the 18.7 million sales received, the gross sales price, we're reducing that from 1.5 from the 18.7 for the sales costs. That's also including our disposition fee, and the title transfer or rate buy down of 7.5% of the sales price, which is about $1.4 million that we set aside for concessions or negotiations or doing this rate buy down, and that's already baked in to the underwriting. So our total sales costs, it's $2.9 million. So 2.9 from the 18.7. So our net proceeds from the lot sales is at 15.8. So if you scroll over here, you can see that when the lot sales start to happen, in here, month 15, 16, and 17, and then again in month 21, 22, and 23. And this starts to pay down these lot sales. So the net proceeds from lot sales, 2.64. So 2.64, you can see that number kind of adds in here. This is how, now getting into the weeds of my underwriting. For those that love spreadsheets and underwriting, you can follow along here. But basically, we have $2.64 million of proceeds now to pay down our debt. So there is no debt to pay for the land. We get into the soft cost assumptions here. We have 2.6 million available, and then we make our payment of 651. So the difference between 2.6 and 651 comes out to 1.9. Now we have 1.9 available to pay off our hard horizontal costs. We have 1.3 costs, construction debt and interest that need to be paid off for this section. So we have 1.9 minus the 1.3. We're left with 646,000 to pay off anything towards our hard costs. So that reduces the amount. The balance here is at 3.7 million. It does reduce the amount, but there's still quite a bit of amount left that we're still going to be paying interest on, which now flows into the following month. Okay, so coming back down here, now we have another, in month 16, we have 2.6 million left to play with, or basically pay our debt down. So no land debt to pay, no more soft cost debt to pay. That's all been paid off in the previous month. No more horizontal costs or debt to pay. That's been paid off in the previous month. And now we have 2.6 left to pay of our vertical construction debt. So 3.4 million is the balance in this month. We were able to pay it off, but we're still paying interest. And so the balance of the next month is 1.6. And again, we have another lot sale of $2.6 million that is paying off the balance. And we're able to actually pay off 100% of that balance, but we're still under construction on these houses. So we're still incurring additional costs. So, the balance does come back and we're paying interest. So, but from this, at this point in month 17, is when we're actually able to start making distributions back to the investors, because we have now paid off all our construction debt and we have surplus left over. And so that surplus now goes towards the investor, pays down their pref, or pays back their principal if the pref has already been paid, and then carries on forward from there. So hopefully that makes sense. I can dive deeper into it for anybody that has any additional questions on that. So if I then scroll across here, so this looks at our total project cost before debt was 12.2. Our net proceeds from lot sales at 15.8. And so we have an unlevered cash flow of 3.5 million. So that's a project level IRR of 38%. If we look at the levered returns, so the total costs after debt of 12.7, loan funding of 9.3, the net proceeds from lot sales is 15.8, which is right here, that 15.8 number. And then our loan payoff of 9.3 million. And then our net levered cash flow is 3.0, or just a little over $3 million, which is a profit margin of 47%, or a project level 46% IRR. And this over here just shows how everything is being funded and paid through the overall lot sales. So in the end, our project level IRRs 46%, and our investor level IRR is at 28%. All right, so now I'm going to go a little bit into the waterfall and show how that structure works, just so it's clear to everybody. and the different tiers. So common equity, again, 3.4 million, and our debt is at 9.3. Sponsor equity, we're actually, the way that I set up this model was if we treated sponsor equity differently, but we're not treating sponsor equity any different than our limited partner equity. So if we did do that, then that's why you would see a number here. So I just wanted to be clear that we are planning to contribute up to 10% of the total equity. And then the way I've set it up was if there was any additional benefits to us putting in that equity, but there's not. We're treated equally. So again, the hurdles, anything from up to 12% is 100% to the investor. From 12% to 20%, it's a 50-50 split. Actually, same going all the way up to 25%, it's a 50-50 split. And then anything above that 25 to 30%, or anything over 25%, it's a 70-30 split. Okay. So then if you've seen these waterfall spreadsheets before, it should make a lot of sense to you. I'm not going to go into all the details here, but I'm happy to walk through this with everybody or anybody that has additional questions or curious how this all works. But this is basically a summary up here for the investor and the sponsor on the cash flows that are coming to them. So basically, like $3.2 million is the equity that's coming out in month 1. And again, we had some financing fees that are coming in month 5 and also in month 9. And then if you recall, there was $975,000 left in month 17 that was able to distribute. So we're distributing that to $975 in month 17. And then once the rest of the vertical construction debt has been paid off, and the net amount remaining comes back to the investor of $219,000, and then 2.6, and then 252. And then, so if you look at it here, the investors or the limited partners here, they're getting all their pref and principals paid back before anything comes back to the general partnership. Okay. So, month 17, nothing's coming to the general partner. Month 21 and 22, nothing's coming to them yet, because we haven't been able to hit that hurdle rate yet, that first hurdle, and paying down the principal. So these just show the different tiers going back to the limited partners. So up to the 12% IRR, up to the 20%, up to the 25, and up to the 30, and anything over 30%, and how that money is being distributed and transferred over, which it all summarizes back up here, what I was saying. Okay. Excuse me. So this is just showing the flow of funds and how all the payments and accruals are being paid. So I'll just go through tier 1 here, for example. So this is tier 1 being the 12% preferred rate of return plus the investor principal. So the investor puts in 3.2 million, and the balance being 3.2 million in month 2, but they're accruing basically $30,000 in basically the pref, which is 3.2 times that 12% pref, and then that's accruing each month. So first month it's $30,500, and then it goes $30,789, and it's increasing. So that accruing amount is increasing until we are able to make our first payment of $975 and reduce the investor principal, right? So investor principal in month 16, 3.9, and then we're paying $975 off of that 3.9, reducing it to $295. But again, there's 3.9 coming up to here. There's accrued interest, of course. We're able to pay that down and left with 200 that balance to 2.9 million. And it continues like that as we are able to meet that hurdle, and then we get into the next tier. Okay. All right, so as far as the sensitivity analysis goes, so let's look at basically this box right here. Okay, and so our this is the basis in my underwriting is 625 for the lot sales and our permitting timeline of 4 months. Now remember, our development partner was able to sell Dietz Elkhorn units or the duplexes for 650,000. So I could show that the basis is 650,000 here, and the 28% IRR would be increased to 31% IRR. But I'm using some additional level of conservatism in my underwriting. But we could potentially hit 650,000 and achieve a 31%. Now, if we were to decrease our permitting timeline by the 2 months, say like if you recall back in the schedule, the bird nesting window, if there were no birds that were there, we could potentially start earlier, 2 months earlier, and then increase the IRR from 20% to 30%. Or if we sell these houses or duplexes at 650, it increases from 31% to 33%. Now on the flip side, worst case scenario, if we had to sell these houses for a huge discount, and our permitting timeline, say, took 24 months, which is a 600% increase, and we sell it for 575, it's a 12% IRR. Okay, so the case of that happening is very low, but I at least wanted to show on the sensitivity analysis that if we were to sell these at a very low price and the permitting timeline was a lot longer, you're still getting a great return for the investors. Not the best case scenario that or basis, I should say, for 625, but still a profitable project. And on the flip side, if it was everything, we hit it out of the park, we sold these things for 675, and we were able to get our permitting down to 2 months. That's a 37% IRR to the investors. Now, if we look at the sale costs versus the building costs, okay, so our basis at 625 for selling. For the sale costs, and then 240,000 for the construction basis, okay, to get to the 28% IRR. Now, like I said earlier, with the tariffs, it accounts for basically about an 8% increase to the overall building costs for fuel, lumber, and petroleum products. So if that 10%, say 10% increase at 264,000, and it would reduce the IRR from 20% to 23%. But if we sold these units for 650,000, then the IRR is at 26%. Worst case scenario, selling these at 575, which is highly unlikely. Just looking at an absolute worst case scenario and a 20% increase in costs, which is not really, in the cards, but it's a 1.7% IRR. So that's why I like to use the 625 as my basis. 600, then maybe the low end, but 625 is a good basis because we're already seeing sale comps at 650, and we know what our building cost is. And remember, I already increased it from 235,000 to 240,000, so I've increased it the $5,000 already for that. Okay, so that's the sensitivity analysis. Now, when it comes to rent comps, rent comp study, so for the investors that are investing into this deal, they're not interested. I guess they don't need to be too concerned with the actual rents of these units. But if you were an in buyer, of course, you're looking at what do these properties rent for and the overall cash flow. And so our partner 5S Invest 5S has they developed, they have great relationships, investors that are looking for this type of product in asset class, and they're looking for properties that cash flow anywhere between $600 a month and $1,000 a month, and so they've structured their financing and their deals to show for that, and that comes out to about a 6% cash on cash return. That is pretty turnkey for the investor. They're buying that duplex and they're achieving a 6%, and it's based off of basically rents of $2,000 a month. So I did my comp analysis to look at other single family homes that are renting in this market, in looking at less than 5 miles. This is basically from 0 to 4 miles, and then I did everything up to 5 miles down here. Average distance of 1.9 miles from this property. The average age is 2005. So this is a product, these houses that are renting are 20 years older. Don't really have any of the features or the finishes that we're including in our development project, and they're all three bedroom, 2-bath, square foot of 1,700 square feet. All of them have a 2-car garage, and average rent of properties in that area reaching $2,000 in rent, 2010, and we're renting these out at basically just under $2,000. And it is Class A product, Class A finishes. It is almost 20 years newer on average. And then I looked at everything that was within basically like a 5-mile radius. And again, it was 2006, renting for 1,700 square feet, renting for $2,059. But what I wanted to also share is there is a development project about 5 miles away that is currently under construction, and it is actually a build-to-rent community that's called the Alaro. It is a very large build-to-rent community, but they also have 3-bedroom, 2.5-bath units that are just under 1,400 square feet, and these things are already advertised at just under $2,500 a month in rent. So this is 5 miles away, brand new product in a very large community that they're able or advertising $2,400 in rent. So we should have no issues getting up to $2,000 in rent for these units. All right, and then as last here, just as far as the limited partner returns. So again, if you were to do a $100,000 investment, you would receive your return of capital basically in year 2 with $50,000 of additional profit. So the total return of capital back to the investors is $150,000 in by year 2. Anticipated timeline of 1.8 years. That equates to a 28% IRR. The return on investment is a $50% return on investment, and an average annualized return of 27%. That's basically 50 divided by the 1.8 years to get to the 27. Equity multiple of 1.5, meaning that you're increasing from 100 to 150, which is the 1.5 equity multiple, which is similar to the 150% cash on cash. That divided by the 1.8 years is 81% average cash on cash return. So I believe that's everything that I covered here. And in diving deep into this underwriting model. Again, happy to connect with anybody if anybody has any questions or wants to dive a little bit deeper into how I structured this. Like I said, I built this thing from scratch and tested it actually against other similar models that are for development projects, just to confirm my numbers are right. But we actually compared this model to our partners Invest 5S, and they got a very simple static model, is what I call it. They don't take the time into consideration when they're doing their underwriting, and they were getting similar returns using a static model. Using a dynamic model like this that is also related to time is more accurate when you're trying to calculate the internal rate of return. So anyways, hope that was informative. Happy to answer any questions that you may have, and hope you enjoyed this video. I'll see you on the next one.